Okay. Hello, everybody. Can you hear me? Everything going good? I am live right now. And if you can hear me, please let me know. You can pop me any questions. Today, the weather is good. Good weather today. And it's nice and warm and hot. So, yeah, we're having a good time. So, if you can hear me, please let me know. And if everything's good, let's get it going. Start rocking and talking about our charts, and the market bell goes off in 6 minutes. 6 minutes we have until our bell goes off, and I'm super excited about that. So today is the 26th of November 2025, and it's almost Christmas, guys. Almost Christmas, and that's also going to be another big It's going to be another big and massive time for the stock market. And we are super excited about that. So, yeah, I hope today I can get everybody on the live stream today. And we will just be talking about the markets and some summaries and strategy sessions. And it will be a pivotal day in the trading week. But tonight we are going to look far beyond the daily noise. Usually, live streams like these are exciting, so I will hopefully bring you some exciting news today and some hype. And they are about the next big thing. Tonight, I am asking you to lower your excitement and raise your focus because tonight is about structure. We are all standing at the edge of December. Okay, guys. For the retail trader, for the amateur, December is a month of confusion. A month of confusion? Do you think so? What do you think? But holiday distractions and gambling. So December is a month of confusion, holiday distractions and gambling. So don't gamble, guys. We don't like to gamble around here. We want to keep it cool and not gamble. Don't gamble your cash away, guys. So December is a month of distractions and gambling, but for the institution, the professional funds, the quiet money, December is a month of extreme precision. So tonight, I'm going to walk you through the logic of the market. I will take you inside the institutional mindset to show you how big money prepares for the end of the year. We have a long session ahead of us, 90 minutes of deep analysis. So here is our roadmap. First, we will dissect markets structure and why we issued specific guidance to sell certain assets today. Second, we will open the institutional playbook to understand liquidity, sector rotation, and net asset value pressure. So yeah, those are going to be important things we will have to talk about. And third, I will reveal the 3 high probability time windows of December. So yeah, there will be 3 high probability times we will talk about. And finally, we will discuss why structure beats talent and the 3 judgment models we use to filter out the noise. So yeah, we got 3 models that we use to filter out the noise, and that's going to be important for us. So if you are here to gamble, this session will bore you. If you are here to build a career in the markets, then I think you are in the right place. This session will be your foundation. Okay, and we have 1 minute to go for the market bell. Let me see if I can get the bell noise. Okay, I got the noise. And in a few moments, we will get the market open. And then we will talk about Microsoft, Oracle, Palantir, stocks, bonds, US Treasuries, bond yields. And we are open. So let me. That is the market bell. The market bell is going off. So let's get started. Okay, cool. So yeah, everybody, once again, my name is Andrew, and I am here today to give you some good information about the stock markets. We will be talking about finance, S&P 500, Nasdaq, stocks all around the world, EFTs, and yeah, just if you want to know anything else, just let me know and I will be able to help you guys. Okay. So yeah, we can see a lot of action, a lot of green movement today. So the Feds probably did something. They probably reduced some cuts, or they reduced some information that is going to be fundamental to the foundation of what we will be needing to go forward. So part 1, we will do trends and the logic of selling. Okay, so let's look at the immediate reality. Let's talk about today. Wednesday gave us very specific signal, and it told us when we need to analyze the market structure from this morning through to the close. We are not just looking at green and red candles. We are looking at the intent of the capital behind them. So we are looking at the intent of the capital behind them, which means we have been monitoring 3 critical elements all week. And one of the elements that we have been monitoring has been trend direction. Number 2 has been momentum sustainability. And number 3 is liquidity conditions. So what did we see today? We saw divergence. We saw rotation out of overheated and overextended names. Okay, so let's look at the S&P. Nice. We saw rotation out of overheated and overextended names, and we saw quiet stabilization in sectors that have been suppressed for weeks. This tells us that the market is preparing to shift. So this line, I drew this yesterday, guys. So when I drew it over here, the S&P 500 was trading around here, and we saw it go up. Okay, so we saw a quiet stabilization in sectors that have been suppressed for weeks, and this information tells us that the market is preparing to shift gears. Now, many of you saw our guidance today. We advised clients to sell specific positions, and I want to stop here and explain the why. I want to explain the why, and in the retail world, selling is viewed as a failure. Okay, you buy a stock, you hope it goes up, and if you sell it, it feels like giving up. So, once more, in the retail world, selling is viewed as a failure. You buy a stock, you hope it goes up, and if you sell it, it feels like you're just giving up. But no, I don't think that is the right mindset to have, because if you're going to buy something and you hope it goes up and you're making money, that's good. But if you want to sell something and you see it going down and you can make money off that, and that's excellent. So in the institutional world, selling is not failure. Selling is preparation. And we guide you to sell today because a clean December requires a clean structure. Cool. A clean December requires a clean structure. Imagine your portfolio is a warehouse. If your warehouse is filled with old, slow moving inventory, which in this case, stocks that are chopping, going sideways, stocks that are losing momentum, and stocks that are structurally broken, you have no room for new inventory. So we need to get new inventory in our closet. We need to get some new clothes, some new shoes, because the old stuff isn't sticking with the trend no more. Okay, we got to rock out some new things and some new gear. So, if you have no execution space when the high probability opportunities of December arrive, I just want to draw a nice line here for our volatility index. We can go from here. Let's go till there. Okay. So when the high probability opportunities of December arrive, and they will arrive, you will be paralyzed. So you're going to be paralyzed. Oh no. You will be stuck holding dead capital, and you don't want to be holding dead capital. So watching the market move without you, it's not a good sign. There's been so many people that I know that would have loved to be in finance or in stocks, and they get so angry and upset when they hear people, when they hear that the market's being moving now without them. It's just going around to places, and they wish they could be there. They wish they could be there and go crazy and make some bags of cash. Okay, so why I said we sell now to free up mental and financial capital for later. Let's look at the specific logic behind the stocks we analyzed today. Okay, so the momentum trap. Case study 1. Let us look at the S&P 500. S&P. S&P. So the momentum track. Take a look at the first category of stocks we discussed. These are companies that had a strong run in October, sorry, in October. They had a strong run in October, but have spent the last 2 weeks pulling in lower highs. So these stocks have been going crazy in the past 2 weeks in terms of going down. And if you look at October, sorry, I'm mixing up my months. So we have October over here. We had some nice momentum on Google. Apple in October. Had some momentum over there. Netflix, not that good October. Had a good first quarter of October. And then boop, they went down. Tesla, October wasn't the greatest. Let's check the S&P 500 in October. S&P, yep, it did a good move. Massive sell-off on the 10th, but not a big worry. Then let's check out Microsoft in October. Microsoft, Microsoft's also been battling, but yeah, they have been having a massive time of loss at this time. So Amazon also back at their support zone. And October, Broadcom still kind of at a nice support zone. So yeah. Okay. So we will see what's happening with all of these other stocks as well later throughout the stream. And if you guys have any other information, please just let me know in the chat. Okay. In the chat, I shall be there. So retail traders look at this and say it's just resetting. They look at this and they just say everything is resetting. And it will come back. So the institutional algorithm looks at this and says momentum decay. When momentum decays while the broader market is flat, there is a distribution signal. So there is a distribution signal, and that could be what we are looking at right now. Okay, so we sell here not because the company is bankrupt. No, we're not bankrupt, guys. But because the time cost of holding it is too high. We don't want to be holding positions that we don't really want to be in. We want your capital moving, not parking. Yeah. So right now everything's parked. We got Thanksgiving coming up. Let's see where money moves. Is it going to be from institutional or is it going to be from retail? Let's see. And case study 2, the liquidity gap. The second category involves stocks with thinning volume. Okay, thinning volume. So you might see the price holding up, but if you look at the volume profile, it's vanishing. And low volume at highs is dangerous. It's danger, danger, danger. Okay, so let's get my volume, 24-hour volume. And we got a RSI on top. Okay, so we got highs, but low volume. Okay, we got highs, but low volume. So what does that mean? It means that there are no new buyers stepping in to support the price. So we could potentially see it go a little bit down, but we will wait and see. If a small wave of selling hits, these, if a small wave of selling hits, these stocks drop fast. And we guide you to exit these positions to protect your baseline. Okay, so we want to protect your baseline. We don't want you to be in positions where we've got no volume but the price is high. Okay, so once again, it means that there are no buyers stepping in to support the price. So who's going to support the price if it's so high? Nobody, which in turn means that the price is going to go down. Okay, so we need high volume at a high price. Low volume at a high price ain't good, guys. Ain't good. It's not what we want. So yeah. And then case study 3, the almost trade. Then there is the third category. Stocks we actually like for December, but not at today's price, because we all like stocks, right? But not at today's price. Maybe Nvidia. But yeah, not at today's price. So this is a sophisticated concept. Just because a stock is good doesn't mean you hold it through a correction. So just because a stock is good doesn't mean you hold it through a correction. We sell now to re-enter lower. So that's kind of why I'm also looking at volume lately, and we got highs, for example, on the S&P 500. So I do expect it to come down at a lower price. That way we will all enter again at a good position. So we're selling now at a high, we're taking our profits out, but it's not moving as much as we like, and how much profit that we are currently getting, I don't think is what everybody wants right now. Okay, so we capture the spread. That is how you compound returns. Capture the spread, and compound returns. Every decision I'm showing you tonight is designed to create execution space. December's opportunities do not reward cluttered portfolios. So get rid of the stuff you're not selling, or get rid of the stuff that's not moving, that's choppy, that's going sideways, that's not giving you any greens, because we want to see a green portfolio. And a green portfolio is good. So they reward clarity. So if you feel uncomfortable selling today, I want you to reframe that emotion. Okay, just reframe it, guys. Just chill. If you feel uncomfortable selling today, I want you to reframe. You are not losing a position. You are gaining an opportunity. So you got to understand that, guys. If you sell your current position, it doesn't mean that you're losing. It means that you're currently in a position to make more money, in a better position, to be in a better state, and have a green portfolio. Okay, so you were gaining an opportunity, and we do not guess December. We prepare for it, and preparation begins with clearing the deck. Okay, clearing the deck. That is what we're going to be doing. Okay, so that's going to be an awesome time for everybody. And yeah, I hope you guys are enjoying the stream so far. I've finished my first part, and I hope you guys are all good. Okay, I just need to check something, make sure we all got locked and loaded. And yeah, we are good. We are excellent. And nothing can stop us right now. Nothing can stop us. Okay, so lean in, guys. This is the insider section. So I want you guys now Let's upgrade the conversation. I want to take you out of your home office, out of your trading app, and place you inside a glass-walled conference room in Manhattan or London. Okay, so I want to take you out of your home office, out of your trading app, and place you inside a glass-walled conference room in Manhattan or London. And I want to give you a guideline, genuine institutional perspective on what big funds look at when the calendar flips, when it flips. Okay, so I want to give you a good look, and we will also look at some good information that's currently out right now. So let's just see if we can find them. Okay, so and so yeah, remember, we're in a glass conference room in Manhattan or London, and I want to give you a genuine look at what we're going to do. So most retail investors think institutions have a crystal ball. They think we predict the future. We don't. Institutions do not predict at all. Okay, they don't predict at all. Institutions position, just like me and you. We all in positions, and we all in these positions together. So that's one thing we have to be looking at. And there is a massive difference. Prediction is guessing. We ain't guessing here. Okay. We're not guessing here. That is not what we plan to do. Okay. We're not guessing. We are doing some calculated moves. And I'm looking at MasterCard right now. Doesn't seem to be the greatest. So yeah, let's just check out MasterCard. Where are my tools? Ah, right here. Let me put it here. Right here. Okay. MasterCard, let's draw a line from the bottom all the way to the top. Okay, cool. And then let's draw our ray down to the bottom for MasterCard. 1, 2, 3 touches. 1, 2. Okay. Not too bad. Not too bad. Not too shabby. And if we go down on the 4-hour, so here, 1 hour. Interesting. Interesting. That is it ideally what I want, but it's not giving me that. Okay. So let's just change this a little bit down to there. And we got it hitting that wick. Okay, cool. So yeah, prediction is guessing and positioning is probability. Positioning is probability. I'm going to say that 2 more times. Positioning is probability. Positioning is probability. At the end of every year, from the largest sovereign wealth funds to the sharpest hedge funds, the focus narrows down to 3 specific drivers. And if you understand these 3, you understand December. So, there are 3 specific drivers, and if you understand these 3, you understand December. Number 1, liquidity trends. Liquidity is the oxygen of the market. Without it, nothing breathes. Nothing breathes without liquidity. We got to see liquid money coming in and out. Without it, nothing breathes. Then retail traders look at the charts first. Institutions look at liquidity first. What we are watching right now is we are watching the dollar and we are watching the US Treasury yields, the 10-year yields. Okay, 10-year yields. Let's see if we can, yeah. And we are watching VIX, the volatility index. Okay. So we are looking at the volatility right here, and it's terrible. Okay, so below 30, if we got it on a RSI, that means it is oversold. So right now might be a good time to buy some dollars. So people overseas, they really want to buy more dollars, but they want to buy it at a cheaper price. Okay, so here is the formula. When the dollar weakens, it acts as a tailwind for assets. A tailwind, okay. When yields stabilize, it lowers the discount rate for stocks, for the growth of the stocks. So when the VIX drops, it signals that insurance premiums on stocks are cheap. Okay, encouraging buying. Right now, liquidity signals are mixed, but they are improving. So we are seeing the dollar hit resistance. Okay. We are seeing the dollar hit resistance. We are seeing yields cool off slightly. So this tells us the institutional algorithm that December has a green light for specific windows of time. Okay, cool. So institutional algorithm tells us December has a green light for specific windows of time. Right now, we are looking at a specific window. Is it the right window? I don't know. You don't know. But we have to do some technical analysis and some fundamental analysis to find out exactly what we need to do. Okay. And the second driver is sector rotation. This is the most critical concept for you to grasp tonight. Okay, number 2, the most critical concept I want you guys to understand tonight is sector rotation. So money does not leave the market. It moves around the market like a merry-go-round. Money's always coming in and money is always going out. Money is always coming in and money is always going out. Toward year end, institutions rotate money in a very predictable hierarchy. So we got a hierarchy with where money goes. And it's usually, well, it's in this order. So money is always going into technology. Money is always going into consumer goods. Money is always going into raw materials. And money is always going into defensive sectors. And why does this happen? Why? Because funds need to rebalance their risk exposure before they publish their annual reports. Okay, let me repeat that one more time. Because funds need to rebalance their risk exposure before they publish their annual reports. So imagine a fund that is heavy in tech stocks. Heavy in tech stocks. Okay. That have doubled down this year. So imagine a fund that is heavy in tech stocks and they've doubled down this year. They're going harder, more into Microsoft, more into Oracle, more into Palantir, more into Apple, more into Nvidia, more into semiconductors, more into AMD. They are sitting on super massive profits. Massive gains, insane gains, millions and billions and trillions of dollars of gains. Imagine. So they cannot risk losing these profits in the last weeks of the year. So they don't want to lose that profits. So what do? They sell a portion of high risk tech and they move that money into stable dividend paying defensive stocks or consumer staples. Okay, so sector rotation, guys, super important thing that I want you to grasp today is that these companies, they buy a shit ton of Microsoft, Oracle, Palantir, Apple, Nvidia, and more. So then they get super high gains and they don't want to risk losing these profits in the last year. So what do? They sell a portion of high risk tech and then they move that. So that, for example, they sell $500 million worth of Microsoft. Then they move that money into a stable dividend paying defensive stock. Something maybe like uh, ExxonMobil, Chevron, and EOG Resources, Expand Energy Corp, EQT Corp. Maybe put some in real estate, but not really. Farm, raw materials, aerospace, GE, Boeing, TDG, HWN, or they'll go to consumer defenses, something like Walmart, Costco, Wholesale Corp, Target. Target's been doing good, and Dollar Tree as well. It's been doing excellent. Okay, so this causes tech to stall and defenses to rise. Okay, so we can see defenses, GE, Vernova is doing good, and all this other utility and energy stocks are paying good dividends. So when sector rotation happens, this causes tech to stall and defensives to rise. If you are a retail trader blindingly buying tech at the top in December, you are buying exactly what institutions are selling. Okay, you're buying exactly what institutions are selling. So don't buy in December when stocks are high, because if you're going to see major sells or big red candles, that's when these institutions are putting money into other other parts of the sector in the stock market. They're diversifying. Ooh, Robinhood up 8% today. Wow. Amazing. Okay. Dell 2.5%. Autodesk, one of my favorite companies, 7.18%. So you must align with the rotation. Don't fight it. Sector rotation is the institutional version of cleaning the house. So they're basically cleaning the house, getting rid of old stuff they don't want anymore, because a new time is coming. And number 3, net asset value, NAV pressure. This is the part retail never sees. This is the human element of the machine. Okay, this is the human element of the machine. Every fund manager, every portfolio manager has a scorecard. That scorecard is their net asset value. Net asset value. At the end of the year, their bonuses depend on it. Their ranking depends on it. Their ability to raise money from clients next year depends on it. Because of this, December has behavior that is driven by NAV protection and NAV inflation. So, once again, net asset value protection. So, at the end of the year, the ability to raise money from clients next year depends on it. Because of this, December's behavior is net asset value protection and net asset value inflation. Okay. Window dressing. Managers will buy stocks that have performed well all year so they can show them in their year-end report. They want to say, look, we own the winners. This creates a natural bid for strong stocks. Okay. And another point I want to talk about is risk aversion. No manager wants to blow up their year in the last 2 weeks. Ha. Okay. They will avoid unpredictable risks and they prefer safety. So what does this mean for us? It means that the market generally drifts upwards, but in a very controlled, low volatility way. Institutions compete not on predictions, but on the stability of their NAV curve, so their net asset value curve. Okay. So I got Louis Vuitton opened up here. Just want to draw some lines. See what's happening with LV, Louis Vuitton. Boom, boom. Oh, over there. Okay. And let's draw a line from the top. Ooh, almost perfect. Okay, cool. Just bring it a bit lower, right like that. Almost, almost, almost. Okay. So we got 1, 2, 3. Almost got 3 touches, but I won't consider this a touch because is that one touching? Yes, it is, but I wanted to touch more. Okay. Okay, cool. Yeah, almost 1, 2, 3 touches. So we got a clear trend indication for Louis Vuitton at the moment. That it's in a downward trend. And we will see what happens now recently. So over here we have a nice support zone. Support. And over here on top we got a nice resistance area. Okay. We got a nice area of resistance. Let me draw this box in. Yeah, right here is a good area. Of resistance. Cool. So if it possibly goes over here, that's when we can put in some sells, and if it goes in this area, that's where we can put in some buys. Okay. So during my years working inside institutional environments, managing strategies with significant capital, this rule was absolute. This rule was absolute. December was never about being a hero. It was about being stable. 1 year, we had a position that was underperforming. Okay. We cut it in early December. Not because we hated the company, but because it looked ugly on the report. Yeah, this was a couple of years back, so we kind of had something on our on our report, and we didn't want that anymore. Okay, because it looked ugly, 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 ugly. And by removing it, our curve looks smooth. The next year, capital inflows doubled. That is the game, and we are here to help you play by those rules. Okay, we're going to play by those rules. It's exactly what we are going to do. Okay, so let's go check out AMD. AMD on the daily. Let's move that line a bit more. Okay, so yeah, we got a interesting area of AMD. So AMD's also gone up quite a bit. Okay, now part 3, guys. The next part of this segment, we are going to talk about high probability time windows. Okay, so we have discussed the why. Now we must discuss the when. The when. What are we gonna do? Timing is everything, right? So we gotta know when to time, when we're gonna go in, when are we going to go out, what are we going to do, when are we going to eat, when are we going to sleep, when are we going to eat food, all of those things. Timing is everything, and it's the same with stocks and trading. We can't just go in anytime. No, we have to be patient. Be patient. Okay, so you can have the right idea, but if you have the wrong timing, you will lose your money. You will lose all your cash. And the easiest way to make money in December is not by chasing the market every single day. I repeat, the easiest way to make money in December is not by chasing the market every single day. It is by identifying and capturing 3 specific high probability time windows. Okay, 3. Not 4, not 5, not 6, not 7, not 6, 7. Okay, so these windows repeat almost every year. They are driven by the mechanics we just discussed. Liquidity, rebalancing, net value asset. So net asset value, pressure. So now let's break them down. Let's check at Coca-Cola for now on the daily. So we also got Coca-Cola going. Let's draw some lines. Yeah, no. Let's draw one from over here. 1, 2, 3. Yep, we probably got Coca-Cola going in an upward trend. It's going to be nice. And Coca-Cola is also trading at an all-time high. Beautiful. Okay. And on the RSI, it's sitting at a good position. It's higher than the average, which is the yellow line. So when it goes here above 70, we know it's overbought, and if it goes below 30, we know it's oversold. It's too much selling, and the price of it actually means it actually doesn't reflect the current price of Coca-Cola. If it's below 30 on the RSI, it means that people are selling way too much of it, and it should be bought again because it's a really, really strong stock. Okay. And they pay some good dividends. Okay. Yeah, they pay they have got a good yield, dividend yield. Okay, so let's do a downward trend line from the all-time high. Yeah, we can't really do that right now. We're just gonna have to watch it play out. But I can see a nice support zone that we can draw in. It's over here. Okay, we can see price likes to be around this area. Support. And our resistance zone currently for Coca-Cola is sitting over here. Okay. Resistance. Cool. Nice, guys. That's a nice one. But so yeah, it's possible that we could put in a sell opportunity actually for Coca-Cola soon. If it goes any higher than, well, if it starts to reach the $73 mark. Okay. So let's break down the timing windows. Let's get back to that. Post-Thanksgiving inflow. We are approaching this right now. Typically, the weekend of Thanksgiving is low volume. So if you look at Coca-Cola, we got super low volume. Okay. Traders are away from their desks and staff isn't in. Desks are skeleton staffed actually. There's nobody at the desk, or the staff is just there chilling and they don't want to do anything. But after the first week, but after the week, but the week, sorry guys, but the week after Thanksgiving, the first full week of December is often the first clean out move of the month. Okay, so why? Because everyone returns to their desks, liquidity flows back into the system, and that causes some decisions to be made. So, decisions that were paused for the holiday are executed. This is often where the trend for the first half of December establishes itself. So we don't want to be too aggressive before this window. We want to wait for the inflow to confirm the direction. We want liquidity and inflow to confirm the direction of where we are going. Then we ride the wave. Okay, then we ride the wave, baby. So, number 2, second time window. So number 1's at the week after Thanksgiving. The second time window is the start of month rebalancing. That is the first 3 days of any month are crucial. But in December, they are magnified. Pension funds, mutual funds, and automated ETFs rebalance their weighings. At the start of the month, billions of dollars move successful. price is high, it means that people are not really going to support this price. So, yeah. Okay, so if I can put it, it's too risky for us, guys. We gotta not be doing that. So, they buy back their shorts to close them. This buying pressure lifts the market. Okay. So when they sell off those positions, it's too risky, so they buy back their short positions to close them. So that downward pressure, that sell-off pressure, it it will it's not explosive. It's not explosive. I'm sorry, guys. Sorry about that. I'm not sure. Just give me a second, guys. Okay, guys, just give me a moment. Let me see what I can do to change this because I'm getting feedback that. Okay, let me see if I can lower this. 5000 bitrate. Okay, just send a stream. Um, Audio should be fine now, right? Okay. Let me close then maybe some tabs. Let me close Google over here. And yeah, let me see. No drop frames. Okay, cool. And let's go to this something I wanted to talk about. Okay, cool. So this creates a slow, steady drift upwards. It is not explosive, but it is consistent. This is the time to be long, quiet. Just hold on, just hold on, guys. And I'm going to add in. Why am I getting dropped? Going to add in. Why am I getting dropped frames on OBS? Okay. Why am I getting dropped frames on OBS, guys? Network encoding. Uh, Good call. You can hear me now? Everything is good. Okay, good. Okay, guys. Audio goes back. Audio goes back and forth. Back and. Oh no. Everything is okay. Everything is fine. Let me just run the test. So here, let me maybe put this down. Okay. So then there are other things that needs to be done. Let's see what. This creates a slow, steady drift. It's not explosive, but it is consistent. This is the time to be long, quiet. This is the time to be long, quiet, and patient. So, what does this mean for our strategy? It means we do not sprint for 30 days straight. Okay, we do not sprint for 30 days straight. We conserve our energy. We target one window for entry, we target window 2 for trend following, and we target window 3 for profit taking and holding. So this is our their win rate. Not by doing more, but by doing the right things at the right time. Okay, so we got resistance block over here, a resistance in the last 6 months, which is a lot to consider. Just see if I can get some more information. Okay, let me just get some more information on the stream. Where are we, guys? Is everything okay? Nope. Getting dropped frames. Can you hear me? Let me just do cool, all back. Cool. I think we are back. Yes, we are. Okay, awesome. So, okay, nice. We are back. Sorry about that, guys. Okay, so if we are looking at, I see Mr. Tommy wanted us to look at Apple again. So yeah, Apple trading at an all-time high, hit a stock record of $277, up 2%, raising its market value to 4.12 trillion. So it gained 19% over the last year and 42% in the last 6 months. So we got a nice resistance zone over here, and that is its all-time high. We got a nice support zone over here, and we can draw in some more support areas as it really likes the $233 mark. Okay, so I can draw one over here. Boom, nice, easy. 200. So we also got a support level over here, or in this case we can write a resistance. But remember, guys, resistance is also support and support is also resistance. They are interchangeable. Okay, and so let's go and check out. Is there anything else that you guys would like me to look at? Anything else? Okay, because if not, let me just get back on track. Okay, so we are talking about uh, a bunch of things today. We were talking about the net asset value. We were talking about where the 3 windows where we can put our money in. And that's going to be the first 3 days of December. That's going to be a good window for us to look at. We're going to look at the week after Thanksgiving. That's a really good area to look at. And then also we are going to look at the last week of December, as that is called Santa's chart. Okay, because it's been happening for the past 10 years. It's a phenomenon. And why are things always going crazy around that time? Okay, why are things always going crazy at that time? So, and what I want to change now, and part four is what I want to talk about: retail losses and why teams win. So, I want to pause the technical analysis for a moment and talk to you about the trader. I've seen thousands of retail traders over the years. I have seen brilliant people, doctors, engineers, entrepreneurs come into the market and lose everything. Why? Retail investors do not lose because they are stupid. So, retail investors do not lose because they are stupid. They lose because they are unstructured. Let's visualize the typical retail experience in December. Okay, the typical scenario: got December, it's holiday, everybody's having a tequila, everybody's having fun. So, December, Monday, they buy a stock because they saw a news headline. Ooh, they saw a news headline, they're excited. Tuesday, the stock drops. They panic. They panic. Oh no, this was the worst decision of my life. Then they hold it. Wednesday, it drops more. They sell at the bottom. Okay. Thursday, the market rallies. They chase it and they buy back in. Friday, they are exhausted emotionally and their account is down 5%. So this is absolute chaos. Absolute chaos. There's no rhythm, there's no plan, and it is purely reactive. Okay. Now, let's look at the Wolfpack. So it's the Wolfpack are the teams that consistently win, and they consistently win, and they are not necessarily smarter than you. They simply have a superior operating system. For example, they have a unified risk control framework. They know exactly how much money they can lose before they even enter a trade. Okay. And I just want to look at Google for the day, guys. We haven't even looked at Google yet. Okay. Yeah. Um, Meta platforms it, Meta Platforms is in talks to invest billions in Google's AI semiconductors, boosting Alphabet's shares by 1% in the permanent trading. So a lot of talk is that Meta wants to buy Google chips now to power AI related tasks and performance problems and issues, and how they can use it, how they can use Google chips to train new models, new LLMs, new algorithms, because not everybody wants to buy from Nvidia anymore because their prices are high and people aren't really too excited with the direction that Nvidia is going in at the moment. Okay. So, but we do have Google at an all-time high. It shot up nicely. Bam! Massive spike up. And now it's chilling over here at a resistance area. Okay. And then over here we have a nice support zone. So right now is a good time to keep watching Google. They're down 1.5%. And yeah, so we will also get next earnings reports in the next 60 days. So guys, Google is also one that I'm going to definitely keep out, and one that we are definitely going to look at further in our groups. We can chat with Sophia, we can chat with Kiwi, and we can get this going. Okay. So um, a next thing I want to talk to you guys about is a unified risk control framework. They so those Wolfpack, those guys that always coming and they never lose money, they know exactly how much they can lose before they even enter the trade. So they know exactly how much they can lose even before they enter a trade. A synchronized execution rhythm. They don't trade when they feel like it. They trade when the system dictates. Okay, guys. They trade when the system dictates. A consistent approach. That's number three now. A consistent approach. They do the same boring thing over and over and over again because it works. This is why their NAV curves are stable and upward. So what are NAVs again? Those are your net asset value projections. So they want that net asset value to look good. And this is why the retail curve is jagged and downward. Okay. I just want to go back to the chat. I want to see if anybody else wants me to talk about anything specific. Okay. Do you use Fibonacci's? Yeah, I do use Fibonacci's as well. I got my fibs right over here. Okay. Got my fibs drawn down from here. Okay. So we got my 0.618 level, my 0.786, my 0.382, and my 0.236 level. Okay. But I don't really follow the fibs to the T. I more do market structure analysis, draw my trend lines, my price structures, and my resistance. And then at the end, the final part, what I will do is I will add in my fibs to double check if everything is okay, if my analysis is awesome, if everything is okay. So yeah, that is what I am doing. So yeah, guys. For you eCaddy Stanton one, I do use fibs. So just to put that out there, I do use fibs. Okay. So and if you want to know more exactly about how I use it, when I use it, um, contact me and I can get you locked and loaded. Okay, bro. So yeah, and cool. So I also just want to go back to eCaddy. Is there anything that you would like me to look at? Is there anything you would like me to look at for you? Let me know. We got 6 minutes left of this live stream. So let's see. Let me look at NVIDIA for the day. NVIDIA, let's see. NVIDIA is also in an area of price discovery right now. Okay, so it's not very clear if this trend is going to be going down all the way. We still need to give it some time. Okay, still need to give it some time over here and see what's gonna happen. If it breaks out over here, we could potentially see a push, and or if it goes below this, we could potentially see it go back to its previous support levels of July, September, and October. And this was a good run. Okay, so yeah, we're looking at NVIDIA right now. NVIDIA seems to be good. We do have high volume, meaning that people do want this price to be at this price. 180 seems to be good. People want to get in at 180, but if it can go even lower, it's going to be awesome. Okay, so yeah, the Bank of America said that its buying rate on Nvidia and citing sustained demand for AI chips and cloud infrastructure is expected to support resilient earnings for the company into next year. So, let me repeat that. The Bank of America reiterated its buying rate of Nvidia, citing sustained demand for AI chips and cloud infrastructure, which is expected to support resilient earnings for the company into next year. Okay, so potentially next year, Bank of America wants the stock to go higher. And yeah, we could maybe see Nvidia push to 5, 6, 7 trillion dollars in 10 to 12 months, and that's going to be interesting. Okay, so yeah, let me double check. Anything else? Okay, we already looked at Google. We already looked at Apple, Netflix. Nobody likes Netflix. Well, we all like to use Netflix, but so yeah. Let's see what happens with Netflix. This is also a nice support area over here. Okay, but a lot of price actions. We've got one big support area between the $80 to $100 mark. Okay, cool. Um, yeah, and let's check out Tesla. Tesla. Okay, cool. Just exactly what I predicted. Oh my goodness, just exactly what I predicted, and I love it. Okay, but it's fine. Because we do have some holdings of Tesla, so we got a nice resistance zone over here. Okay, so what I said yesterday on the live stream, guys, is I usually draw my trend lines. They're super simple, super basic, but there is a method behind it. And if you want to know more, I can teach you all about that, and I can let you know exactly how to do it because it's valuable. Okay, you can find out a lot of information just by drawing your correct trend lines. Okay. And knowing where to put your support and resistance boxes. So over here I drew one line going down from the high point, one from the lowest point over here, because you can't really draw one here, it's going to cut through the chart. So I drew it over here. And then we had this one big candle. And then Tuesday, it was moving around here. And I said specifically, if it's going to cross this line, we could potentially see it push upwards. Okay. But it's currently now at the price it opened up. So yesterday it closed at 419, and it went up to $424, and now it's sitting back down at 419. Okay, so right now Tesla is also in the region of price discovery at the moment. Okay, so let's just leave it as such. But I also do see some candlestick patterns working out here. But okay, guys, we got 1 minute left, and I think we had a good session today. I think we did have a good session, and we spoke a lot about a lot of information. We spoke about stocks, we spoke about bonds, we spoke about yields, we spoke about the S&P, and a lot more. But I want to thank everyone for staying through this full session. I know this was dense, and I'm sorry about the connection issues. I had a VPN on, I didn't notice. And yeah, I know this was a lot of information, but remember, December requires preparation, not prediction. And tonight we covered the market summary, the logic of selling, the institutional viewpoint, the key time, windows, and the judgment models. So now you have a map, but a map is useless if you do not walk the path. So tomorrow the market will open, the noise will return, the temptation to break the rules will return, and your job is to stay within the structure. Focus on liquidity, respect the rotation, wait for the windows, and trust the models. If you do that, December will not just be a month of survival, it will be a month of significant progress. And I will see you all in the next live session. Let's keep the discipline high and have a great evening.